Hi everybody, and thank you for joining the Louisbourg Quarterly Market Update. I'm here with Mathieu Roy, VP at Equities, and Daniel Robichaud, Portfolio Manager. And we have a fairly interesting market to discuss today. Second quarter returns have been strong, following up on 2020 return, end of 2020, and Q1 returns have been good. Canada kind of leading the way on equities, US and international still posting great returns. We have inflation concerns persisting, which kind of raises the question of continued stimulus. And then we also have this interesting growth versus value cycle that continues to shape markets. So Mathieu, tell us a little bit more about how Canadian markets have performed and the themes developing here in Canada.
Well, I guess Canadian equities are cool again. That's the summary of it. And I think new investors may be a little surprised by that. The last 10 years really have been owned by the US, big technology companies. But the decade prior to that, it was really a resource boom created by China. So the 2000 to 2010 period really was Canadian equities, which was leading the pack because of that driving force.
Right.
The last 10 years hasn't been the case so much. So it's a little surprising for some investors to see Canadian equities being the leader in an up market that we're experiencing today.
Mm-hmm.
A lot of that has to do with an improving economy. You're seeing a lot of demand for goods, in part because of the COVID crisis and because of supply issues. That's creating some pressure on prices. You're seeing it from a commodity standpoint. If you're trying to build something at your house, you're certainly experiencing it.
Right.
But that's good for Canadian equities in general. We still have a healthy weight in energy companies and material companies. Okay. And that upward movement in commodity prices is helping a lot of those businesses which really haven't been valued very dearly over the last little while.
Okay.
And we feel that there's some running room there. It's not a one-way market. You're still seeing strong performance by technology companies, but you're seeing more of a balanced market, and I think that's helping a lot of our Canadian companies.
And Daniel, what have you observed outside of Canada?
Yeah, so of course, a lot of the themes Matt just talked about are relevant globally.
Sure.
But if we talk really about the U.S., we've seen a lot of focus on inflation data. All investors globally look at what's happening in the U.S.
Mm-hmm.
And we've seen CPI indexes coming a bit higher than expected, but as investors been digesting the data, really breaking down where inflation's coming from, I think market got overall more comfortable around where inflation's coming from, and we've heard that word often, transitory, and it seems like the market now agrees that inflation looks more transitory overall. What that led to is yields or interest rates being coming down from the high. We've seen the rotation back into growth, and that's favorable in general for the U.S. equities, which has a lot of exposure to technology or communication services, which big companies like Google and Facebook, and really they're long duration assets that benefit from lower interest rate. Internationally, I think the factor that's the most different is probably the progress European countries has made with the vaccination.
Sure.
A lot of the countries have been delaying the lifting of some restrictions as the Delta variant has a bigger impact. We've seen case ramping up again. Same thing in Asia or Japan. Actually, they've done a pretty good job controlling the number of cases so far, but the vaccination rate remains so low versus other developed countries. And also, it's countries that more exposed to industrials and the supply chain bottlenecks had some bigger impact. So just overall, the economy has been, we didn't get the same rebound that we saw in North America. And that had, we've seen it through the performance, which was a bit softer than what we observed in North America. The other bigger factor also for international equity is just the structural or the structure of the index, which versus the US is a lot less exposed to those technology names. So as example, they have 3 times the weight to technology than the international equities got. So that has also an impact on performance.
And Mathieu, how have we positioned our Canadian equity mandates to perform in this type of market environment?
Sure. I like to mention Warren Buffett. He's the best investor in the world. We can all learn a lot from him. And he likes to say that we should be fearful when others are greedy. We've had a strong run in the markets. So are we there yet? Should we be fearful about equity markets? That's one of the questions everybody asks themselves when they're building a portfolio or investing in equities. And my conclusion is I don't think we're there yet, but I think we should be careful about equity markets. There's some pockets of exuberance.
Sure.
You're looking at a lot of SPAC deals, meme stocks, new IPOs. Some of them are quality companies, but not all. But you're seeing a lot of investor appetite for risky businesses or risky investments. So you have to be careful. That being said, specifically to Canada, there's still a lot of value out there, and a lot of that has to do with resources being underappreciated for a long period of time, meaning that pricing was not necessarily there to stimulate investment. So there hasn't been a lot of new supply for energy, for copper, for all types of materials. And this is creating some pricing pressure here as demand happens. So those businesses are not valued dearly. There could be some running room to have attractive investment, especially if you're focusing on higher quality companies with lower costs. You don't have to be, so you want to have investments in those areas, but you don't want to be heavy in commodities.
Sure.
There's other sectors like industrials. One of the companies that we recently added to is Finning International. They're a Caterpillar dealership in Western Canada in South America. So they're benefiting from renewed interest in energy, renewed interest in copper.
Sure.
There's some value out there in positioning the portfolio in that direction. In the same way that you want to be balanced with your equity allocation, that's what we're advocating today. Within that equity allocation, you also want to be balanced. So consumer staples have very strong fundamentals. You can buy them at attractive prices. So we have a healthy allocation there. But we're also looking for those above average growth opportunities I just mentioned that have maybe a little more cyclical upside and risk associated.
Sure.
Great. And Daniel, could you provide a little bit of insights on our equity positioning outside of Canada?
Yes, Marcel. So really what I like to start with is kind of the big picture thing for us is I like to focus on what I feel we control the most, and what it is staying disciplined and really focusing on our investment criteria and strategy. And that's really buying good businesses, good balance sheet, and at an attractive valuation or reasonable valuation.
Sure.
And then once we do that, it's making sure we got a well-balanced portfolio. We're not exposing ourselves too much to some things that's not intended, and that will hopefully perform well through various scenarios or uncertainty. On the U.S. side, I think at a reasonable price is some of our struggle really in the IT sector. There's a lot of good businesses, so that's why we keep looking. And one example we added recently is Salesforce. They're a leader in cloud CRM software. So we like a lot of the business, but the at reasonable price is the struggle, and that's why it's our largest underweight.
Right.
The offset to this is communication services with the digital advertisers. Facebook and Google is our biggest overweight, and really I think a lot of investors would see those companies as high growth and probably expensive, but the reality to us is they look pretty cheap relative to their growth prospect, and we feel investors are discounting them at a pretty high discount rate just because of regulatory uncertainty. And from our perspective, we just see just more upside than downside from that overall. We think they can keep monetizing their core asset. Also, we don't feel the market's giving them credit for everywhere they've been investing into adjacent markets or different even markets overall. Google with the infrastructure as a service as example, and Facebook with virtual reality. So we see a lot more upside there with those companies, and it has a nice offset to this. If there's another team dominant maybe in the portfolio is our focus on discounters, from retail to wireless service providers. They've just been big market share taker over the long term. We see that trend continuing. They trade at reasonable valuation, and so we think the macro setup is still even favorable for them here. So overall, that's probably the two teams. What big picture, what we want to say is the portfolio is well diversified. We're in 10 of 11 sectors, so we're trying to keep a balanced approach. If you're international equities, I'd say I like to bring it up just because it shows how we focus on bottom up. And it's the IT sector is by far our largest overweight. I just said we find a lot of attractive companies there. In international equities, we got a lot of exposure to the service or IT services, and it's a team dominant in our other mandates too. But we got a lot of exposure there. Also on the software side with the SAP and Sage Group, which we feel the company has been transforming their offering to really meet the demand from consumption on cloud or software as a service, and market still doesn't give them the full credit for that. So we have a lot of exposure there, but overall, I'd say it's same as the US. We've got a pretty balanced approach, 10 of 11 sectors, and trying to keep a very balanced portfolio.
Excellent.